All right, we've got Neil Parag Parikh joining us this morning, Chairman and CEO, PPFAS Mutual Fund. Good to have you with us, Neil. Lots to talk to you about in the current scheme of things, and as we scale that 11,000 mark, what kind of conversations are you having currently with clients when it comes to valuations?
Thank you so much for having me here. So clearly, markets have rallied in the last 3 months, and markets are not cheap as of right now. We think they're pretty expensive. And as a fund house, we're cautious right now. So what we're telling our investors is to stagger the investments. The time to do aggressive lump sum was in March. I don't think that's the time. I don't think right now is the time to do aggressive lump sums, but to stagger the investments and to do SIPs, STPs. And if you must do a lump sum investment, have a 7 or 2 or 10-year time horizon. So simply put, we were greedy in March. We're a bit fearful right now.
Okay, I like that. Cautious at this point of time. What's the investor behavior as well that you're observing currently? Are they being eager to deploy? Are they averse to risk? Is there cautious optimism, as you perhaps suggested, or a bit of concern?
So when the markets are volatile, investor behavior is all over the place. So I think we've seen different behaviors in different people. So before COVID struck, we were sitting on about 12 or 13% cash in the portfolio. And as the markets came down, we started deploying. At that point, we went to our investors and said that to invest at every dip. I think we're getting valuations now, and you please invest. So I was happy that most of them listened to us. But on the other side, there were obviously people who were gripped with fear and who could not invest. Because of the fear or the COVID scare. On the other hand, we also saw a lot of people trying to time the market at that point, and the way the recovery happened, those people could not invest, and they've actually invested recently at higher prices, or some people are just still waiting on the sidelines, waiting for a crash. And thirdly, I think there was a lot of paralysis in decision making. Simply put, is because there was so much information overload. People were trying to get every information, every article, every WhatsApp message, and they were trying to act on it. And even these people were, if they were motivated to put in money in the markets at that point, they couldn't, because there would be some news coming in which would not make them. So these people have again stayed on the sideline. But now what we're telling investors is that, look, markets are pretty expensive. In March, we were deploying money, but now if the market stays expensive, you might see a cash building up in the portfolio. So it's a time to be cautious. And I think a lot of people are listening to us on this front.
Look at the markets right now, 11,000. Who would have thought that at a time we're in the midst of a pandemic? There really doesn't seem to be any, sort of trend of flattening of the curve. There's job losses. There's an economic impact. We're looking at deceleration of growth across the board, not just in the country, but across the world. What explains this sort of disconnect between the macros and the market momentum?
I think the reasons are people probably know that there's a lot of liquidity right now in the markets. The governments or the central banks came pretty early and infused liquidity. Again, interest rates are down. There is no other alternative for investments. A lot of people are sitting at home. They don't know what to do, so they've opened brokerage accounts, and that I hear is also making the markets go up because these people are trading. So again, when these things are happening, I think there is a disconnect because what's happening in the real economy, there is still COVID is still present, job losses are real, economy is not booming, or it's pretty stagnant right now. So that's exactly why I said that there is a disconnect. So it's better to be a bit cautious right now.
Neil, morning, there's almost that left out feeling in the markets as well, when every morning you wake up to global news of an Amazon, of an Tesla hitting an all-time high. And, there is that urge amongst Indian investors to try and diversify and get some exposure to the global portfolios. Difficult though for retail participants with very limited choices out there. But what is your reading on how the US markets are panning out? Well, they too have had an exceptional run since the March lows, but do you think increasingly there are signs of fatigue or consolidation now setting in? Or do you think it's going to be a one-way street up for the next foreseeable future?
Yeah, so again, in the recent past, the US markets have far outperformed the Indian markets. And again, we invest in about 30% of the portfolio outside the country. And a lot of our companies which are in the tech space, like Google and Amazon, have really gone above the pre-COVID levels. So they are hitting new highs every day. Most of our buying was actually done in March, April, and in the last 2 months, we haven't really bought any foreign stock. I think the prices have been going up, valuations have been getting expensive. Though we love the business models of these companies, I don't think they're a buy right now, nor are they a sell. So we are just holding on right now.
Fair point. Also wanted to understand, when it comes to Indian markets, what are the key domestic sectors which you have large exposure to, besides, of course, the global names that you talked about?
Yeah, so when we choose stocks, we use the bottom-up approach. Thereby, wherever we find value, we will invest in those companies, respective of sectors, market caps, or geographies. So that's kind of where we stand. But we are also cognizant to the fact that we don't want one sector to become too big a part of the portfolio, because that has inherent risk. Currently, when we talk, we are heavy on IT, which includes US tech, as well as mid-cap Indian IT, autos, and financials. Though financials, we are underweight to the index. So these three kind of make up a large chunk of the portfolio.
Okay, fair enough. And what have you made of the kind of earnings season that we've seen so far? We've got a decent percentage of Nifty companies that have already declared their numbers. Do you believe that Q1 will, feel the maximum impact of the lockdown, or that the quarters going forward as well, there will be a lot more pain?
Yeah, I think I don't think we've seen the actual dent in this quarter. I think the story will be told in the next 2 or 3 quarters. So I think it will be important to see what happens in the next 2 or 3 quarters for us to really make an assessment of what's going on. So right now, it's kind of a wait and watch.
Okay, fair enough. Is there anything that you would be avoiding in this market at the current juncture? While we have seen sectors like metals, pick up momentum, real estate as well, there are a lot of concerns when it comes to the cyclicality factor, or, the fact that these companies are highly leveraged. Is there any spaces that you would be looking to completely avoid, especially at a time like this?
Yeah, so our preference was always been for low debt, cash-rich companies which are managed well. So definitely companies which are over-leveraged, maybe sometimes in cyclical spaces, in real estate, infrastructure. We'll probably avoid that. Again, we'll probably avoid companies in sectors that we already know is going to be affected with COVID, which could be hotels, airlines, travel, kind of those kind of things. So yeah, so I think it's better to stick with quality companies which have cash in their portfolio, which have cash to deploy, because they can actually increase market share in this time. So they could actually see a growth in this time. So we're looking at such companies.
Sure. What are you making of the relationship between market cycles and the economy currently? I wanted to get your take on that, Neil.
Yeah, so there's a total disconnect. I think there's quite a bit of disconnect with what the markets are doing and what is actually the ground reality of the economy. Again, people are sitting at home. Economy is not really booming. COVID is, we're seeing cases go up with COVID. There's no sign of, there's no vaccine right now, no cure for that. And on the other hand, the markets have just been going on a run. So there's surely a disconnect, and that's why I said it's better to right now just be a bit cautious and take a back seat and just see what's happening. Again, if again valuations are getting a bit on the expensive side on the market in the stock market, so we might see some cash building in our portfolio too.
Okay, great. Thanks so much for joining us this morning, Neil, and talking us through how things stand. Always good chatting with you.
Thank you.
Okay, we're going to take a very quick break. On that note, back with more on the other side.